Yeah, I think everybody's going to get a lot out of tonight. We will go high level and then dig into some weeds. Then I'm going to open it up to a lot of Q&A for folks that just are trying to learn how do you get into this game? How would you buy a multifamily apartment building? And I'm going to focus kind of boutique tonight in the sense when I say boutique, anybody that's in here that doesn't own a multifamily apartment building, meaning a 5-unit or more, boutique is your first deal, meaning a 10 to a 30 unit type property. 10 units to 30 units is going to be your first one. And technically, we would put that in the more boutique multifamily category. Okay. So that's where we're going to be focusing tonight.
This actually question has come up a couple of times over the last few days on our socials and stuff. When it comes, you mentioned right now that your first deal is going to be a boutique of like 10 to 30. A lot of people come to us saying like they've been told to start higher with like a 50, 100 or 100 plus, and that it's the same amount of work to get a 100 plus unit as it is a 10 to 30. Could you kind of elaborate a bit on that since you've done obviously both sides of it, so you can kind of go into it a bit more?
Yeah, no, and that does come up a lot because there's a lot of gurus out there teaching stuff. And I understand in theory why they're telling people, go big, right? Go big on your first deal, meaning 50 plus units and so forth, build a big team and infrastructure and go for it. And I get it because there is economies of scale in doing multifamily. And there's a reason that they're wanting you to do that. However, if you have not done multifamily before, and this is your first rodeo, there's not a chance in heck that you're going to pull that off unless you have somebody you're partnering with who's already done it. You literally have a better chance of breaking into the White House tonight than you do of getting a 50 plus unit apartment deal on your first deal. Okay, that's number one. Number two, when you're trying to do this, there's a lot of pieces. If you're more of a novice and you don't have any resume, right? Because that's people's biggest thing they come up with is, I can't get brokers to call me back. I can't get sellers to respond to me. I can't get the financing. I can't raise money. I don't have this. I don't have that. All that stuff that goes down, right? The limiting belief systems in the brain. And so that's why targeting 10 to 30 units in that more boutique space, it's still large enough, right, to where you're getting value and there's money in it and it makes sense to do it. Our first deal was a 27 unit. When I say getting into multifamily, it was a 27 unit deal in Kansas City, Missouri. So that was still a boutique space. And we did that with myself and 7 other investors. And we took that deal down and we still own it today. Okay. So getting into it's easier to finance. You can actually take it down if you're a newbie. You can raise capital if you have to do that as a newbie. You can get the brokers to call you back in that smaller space, even though you're a newbie. You can handle that stuff because you're dealing with more mom and pop in that space and arena. So being able to take down that type of deal, it's manageable. It's bite-sizable. It makes sense, right? The numbers still make sense. Does that answer the question, Guy?
Yeah, that makes a lot more sense. Yeah.
Yeah. That's why we target that. We show people how to do that. Anybody that comes to us, that's how we guide them and get them to where they want to go. Because just to give you kind of a pathway, right? And I'll jump into that real quick on kind of my pathway. That was our first syndicated deal. But there's a lot before that got me to that point. So I'll jump into that now. How to buy an apartment building in the next 90 days if you'd like to do it. Obviously, you got November and December left in the year, and then you got January, February. So this is a plan for how do we hit 2025 in rock and roll. So the 2008 collapse, kind of walking you through how that was kind of a trigger point in my life that got me to see things a little bit differently. Having grown up learning from kind of a developer builder who was my dad in real estate, he was my mentor when I was young and was learning, was my dad. Incredible. And learned an enormous amount from him of what to do and even what not to do, right? And some of these stories, they're out there. You can Google them just about kind of our family and what went down. And I watched my dad go through over a $60 million bankruptcy in 2008 and 2009 as he had to consolidate his businesses. He was in the build and sell game. So, he was completely self-made. And he was our kind of transitional character in our family where he had a bad upbringing, grew up in a bad household. He went off to Vietnam, came back, got into real estate, was a real estate broker at first, then got into development and construction and kind of went 0 to hero. And he made it happen, completely self-made. Build and sell game, right? Build things, sell things, build things, sell things. So he'd have big pops, but also his income would mimic the real estate cycles. And so come 2008, he had been through multiple cycles. That was a violent one, and it took him down. You know, I think at that time, I mean, I kid you not, it's a ton of stuff even talking about it today, but he had, when that thing went down, about $80 million in assets and about $20 million, I'm sorry, $80 million in liabilities and $20 million in assets. So you can imagine $60 million BK. So that was kind of my intro into the real estate world, was watching that kind of come into it. And in 2009, we had founded our company, the Brennan Pulley Group Capital. And that stemmed really from going and learning about apartments and rental income properties. And I'd met a buddy and we talked about buying rental properties. And that kind of started around that 2010 time, where we went in and we got to one unit. This is literally in the midst of the financial crisis, a $100,000 condo in Murrieta, California, in the midst of the financial crisis. And then we took that. And then from there started buying little duplexes and triplexes and fourplexes. And so by 2018, we had accumulated pretty much with our own money about $3.5 million in assets, 20 units. And we thought we'd made it, right? We said, this is great. We got a retirement nest egg. We're good to go. We're set. And then you start to realize, oh crap, we're running out of our own money, right? We're running out of our own money. So then, okay, how does this OPM thing work? How does other people's money work? How can I get others to invest alongside us as long, with our money and other people's money, and quote unquote syndicate, because we hear that term thrown around. That's what that means. You're syndicating money and buying real estate together. That's what that means. And so that started that. And that really started in 2018, went to a syndication conference out in Boston, Massachusetts, came back from that, met thousands of people, brokers, investors, money guys, all kinds of folks. And what I realized very quickly is we're playing the wrong game. We're playing the wrong game, because we have two choices. We can stay where we're at and control all it with our own money, and that's great. Or we can start to take some of our money in conjunction with others and scale and grow. Okay, and scale and grow. And that's what started the syndication game. So in 2018, we had 20 units, about $3.5 million. Fast forward to 2024 today, we're at 687 units and about $180 million plus in assets under ownership today. Okay, so we have 40% ownership in that. So you have 100% ownership over here of $3.5 million. Okay, it's nice. Or scaling your money correctly with OPM and yours, now we have 40% of 180 million. You do the math, right? That's how you scale money. That's how you do it. And we can teach you that. We're going to show you that this evening. Okay. Does anybody know what BHAG means? Big, hairy, audacious goal. Big, hairy, audacious goal. So my big, hairy, audacious goal is 10,000 units. Like I said, 687 now. To get to 10,000, we got a ways to go, right? But how do you do that? And what you soon learn, and I'm going to really focus in on this for you tonight, partnerships are how you get there. You do not get there alone. We haven't gotten to that 20 units to 687 with all of our own money and doing it alone without partnerships and even co-partnerships, right? On ownership side, you partner, you collaborate, you bring money together, talents together. That's how you do it. There's got to be people that find deals. There's got to be people that raise money. There's got to be people that operate. All of that has to happen. Collaboration, partnerships. That's how we're getting to 10,000 units. Okay. That's how other people do it to get to where we're even at today and where you may want to go, where you're trying to go now, right? You want to start, but then you want to get there. Does that make sense to everybody? Partnerships are everything. And I'm going to touch on that over and over and over again throughout the evening, because it's a critical point that you focus in and realize, what is the big picture for why I'm even here? Why we're even talking tonight? Why we've created a community of well-trained investors around the country who are doing deals, not only for themselves, and we're helping with that, but also collaborating and partnering together. What does that do? It helps us grow, helps you grow, helps everybody grow if you're learning this and collaborating together through community. So that is the big, big picture behind what we're doing. Okay. So that's where that started. That's where that started. And understanding that there's a difference between single family and multifamily. Single family and multifamily. Who here owns single family rentals? Chime in the chat. Just put maybe a 1 in the chat if you own single family rentals currently today. Matt, because you were one of the few that chimed in there. What about, and then Carlos and so forth, what about single family rentals made you want to start there versus go to a 5+ unit property? Type in there your fear or your concern as to why you didn't just go for it in the get-go. Is it fear of making a mistake? Is it fear of losing money? Smaller project with more control based on the time available. Makes sense. Yeah. Money. Makes sense. Yeah, and that's usually what stops people, because they think that they have to have the capital or access to the capital, or that they don't even know maybe how to structure it, right? Because, okay, I'm going to go buy a building and it's a $2 million building. Like, how do I structure that with myself if I'm going to bring in X and then I'm going to bring in investors? Like, how would I structure that? How much would I give up? How much would I still own? How would I put that together legally, financially? Would I still make money? Does it make sense? All that stuff is going to go through your brain, right? And then, yeah, you always wanted to turn single family into multifamily by adding floors. Well, I mean, if you can do that, it's either that or you go buy one that's already done. You can do that too, Kalani. But I love the concept. I mean, all that's very, very important things that stop people from going. But really the biggest difference between single family versus multifamily, single family is very transactional, right? You're typically only paid 1 to 2 ways throughout a transaction, whether it's rental property or flip. Short-term taxes, right? It's short-term income, right? Because you're typically doing it in 12 months or less, and you're chasing the next deal all the time. Lack of economies of scale, lack of generational wealth. It's harder to finance because it's single family versus a commercial property. And then it's good, quick money. It's a great quick money, which is one of the main benefits for it. But you're losing that big time wealth gain, generational wealth, and long-term passive income that everybody's seeking, right? To give them the time with family. So then you go over to the multifamily side and kind of what makes that super unique? Like, why would you do multifamily? Why is it better, right? Why is it one of the best investments versus doing other types of investments in real estate? The monthly cash flow, right? You're paid 5 to 8 ways over the ownership of the apartment building. Did you know that? Like, so if you were to take and I'm going to show you a timeline here, right? If you took a 5-year timeline of owning that apartment building, you're paid 5 to 8 times in 5 to 8 ways throughout the entire course of ownership, multiple times, multiple ways, many of them monthly. And so we're going to go through that. Long-term tax benefits, right? The write-offs, depreciation, bonus depreciation, everything that comes through owning long-term assets. Massive economies of scale. Think about it. If you own 10 single-family rentals in a neighborhood, you have 10 different roofs, 10 different water heaters, 10 different yards, 10 different insurance policies, 10 different mortgages. Right? One tenant leaves one of your houses, you go from 100% occupied to 0% overnight. You take that exact same 10 tenants, you put them in one building. You have one building with 10 units. What do you get? One tenant moves out, you go from 100% occupied to 90. You have one roof, perhaps, maybe one boiler water heater system, one insurance policy, one mortgage, economies of scale of repairs. You get the point, right? You get the point. Generational wealth, and it's big money, much bigger money than single family, much bigger money than single family. So those are the main differences is why people choose multifamily over single family, okay? So has anybody ever explained, or have you ever been asked for yourself, and we're going to do this quick exercise, the 7 mountains, okay, the 7 mountains that move a nation and inspire people. Have you ever played this game? Because I'm going to go ahead and put up a poll right now. I want you to think about this, because money is a great motivator. Money is a great motivator, and it'll get you going, which is why you're here tonight, right? You want to learn about multifamily. You want to know how the money works. You want to see how much you can make, and then maybe you want to go do it and start it. And money's a great motivator, but it's not going to keep you going. Like, you need something like internal in your belly that's really pushing you. And all of you have it, because money is simply access to choices, right? Access to time, right? It gives you choices and opportunity, right? That's what money does. What are your 7 mountains, right? And I want you to pick 3 to 4. 3 to 4 of these mountains, you can look at them in the poll there, that most inspire you, that you're excited about. Is it sports and culture? Is it education? Is it helping and teaching people? Maybe it's a successful business. Maybe it's family. And when I say family, it's not just your personal family, it's also philanthropy, right? It's giving back, helping others, leaving a legacy. Is government, right? Maybe it's politics and government. I mean, we got this thing called an election, I think, in a week. Right? Maybe you like government and politics, or maybe religion. Maybe you're into the faith and religion-based stuff, and that's a huge passion for you. And you want to utilize things you do in your life, make money, but then go do things that you're most passionate about. So these are passion projects, because this is what's going to get you out of bed every day when you're tired, when you don't want to do it, when you don't want to do something that you know you need to do. These things are going to help you. Okay. These are the 7 mountains. So then kind of looking at it and kind of showing you how you apply this, right? How would you apply this? So for me, business has to be the number one because that's a driver, right? You have to have a successful business that then allows you to take that and move money, call it, from the business into other arenas, right? Whether it's media, right? In doing things in the media space. And then from there, you can take it into things that are even more passionate, which is education, which is what we're doing tonight. Created a community to help educate other people to learn how to do multifamily, become great investors, and then collaborate and partner around the country, which helps everybody win. Remember, partnerships are everything. How do you think I'm getting to 10,000 units? I'm not doing it alone, right? Partnerships, collaboration, people in the community, people finding deals. Remember, you got to have people to find deals, analyze deals, put things together financially. You got to have people to manage, run, and operate. All those things have to happen, right? There's skill sets in each of those. Then you have family, which is philanthropy. It's not just your personal family, but philanthropy. What are philanthropies you love? For me, it's Tunnels to Towers. I don't know if you've heard of that one, but that's one we're really passionate about. The SEAL Future Foundation, that transitions Navy SEALs from team life, team guys, into civilian life. And then dealing with disadvantaged kids around the country, giving them opportunities where they otherwise maybe grew up in a bad environment, helping them, right? Giving them the belief system that they can do it, providing mentorship and role models behind the scenes. So these are passions of mine, but business drives it, right? The money in the business drives it, that then allows all those other things to happen. So that's how you connect those dots on it, okay? That's how you connect the dots. And then you do things like this, and you collaborate with great people. I don't know if any of these people, you know it all on your screen, but I don't throw it up to kind of flex. It's just to kind of show you the opportunities and things that you get to do when you put yourself out there and you have successful businesses, and then you get into media, you do education, you help other people out, you collaborate, you grow, you invest, you do things, you get the chance to meet some really, really cool people and collaborate around the country. So more to it. Okay, let's get down to business. And I don't care if you're buying a 2-unit property or you're buying a 100-unit property, okay? It's going to follow the exact same pattern. You have to know how to find deals, right? How do you find good deals? Then after that, how do you analyze them, okay? How do you analyze the deals that you're looking at? And then after that, how do you finance and capitalize them, okay? How do you finance and capitalize, structure these deals? How do you close escrow on them? So now you found a deal, you've analyzed it, you've done the financing, raised the money. Oh my gosh, how do I close escrow, do inspections, due diligence, all these things? How would you do that, right? But based on your guys' answers tonight, the first 3 are where we're going to focus, right? Finding, analyzing, and financing and capital structure. Because closing and managing, I don't want to go too much over time tonight. We could spend a lot of time on that too. But it sounds like everybody, we can focus on the first 3. Fair enough? Fair enough? Awesome. But that's where we'll focus tonight. So finding, analyzing, and financing. So has anybody ever played this game with you? Money to most people's freedom. It's choices. It's this, it's that. But really, when you look at the U.S. economy, the capitalistic system as we know it today, money is a game. It is a game. And if you understand how to play it correctly, and you understand how the capitalistic system in the United States is designed, then you'll realize, oh crap, what am I doing? Because I was in the contributor role for many years as a W-2 employee, doing well, making a good income. I asked you all earlier, what are you doing? You're like, yeah, I'm making good income, have a good job, but I want to level up, do other things, put my money, invest, maybe get out of the rat race, stop working for the man, all those things, right? So to do that, you have to understand how this cycle works. So you have creators and you have contributors. You have creators and contributors. Creators are investors, right? Entrepreneurs, business owners, 1099 people who go out, they create products and services into the marketplace that are consumed by contributors. The money leaves the pocketbook, right, of the contributors, and it moves over to the pocketbook of the creators, and the creators get rich. Right? And you're making good money as a W-2, not saying you don't, but I'm saying you're contributing, right? You're not creating in the economy. You're not moving enough money. So because you're not moving enough money, the IRS doesn't really value you that well. So they're not going to give you a lot of tax breaks. They're going to give you your basic ones. So then each year you're doing your taxes, right? Some of the money comes out pre, right? But all that stuff comes through. It's because you're not moving enough money in the US economy, so that the IRS is not going to give you a lot of tax breaks. They give the most tax breaks to people that move money. And if you move a lot of money, you get the most tax breaks. And that's how the IRS works, because they want creators over here, right? They want creators over here to grow businesses, hire people, CapEx, improve, right? Capital expenditures in the businesses, go buy real estate, move millions of dollars, do things, because by moving money, you're creating capitalism in movement of money. And by doing that, you're creating wealth. And by creating wealth, the IRS loves you, because now they're going to get a piece of taxes down the road. It's not like they're not going to get theirs. They're just getting a piece of a bigger pie later down the road. They're like delayed gratification. I mean, the IRS is not giving all the tax breaks to creators out of their good heart. They're doing it so the creators can grow, get to a certain point. At some point, the IRS is going to get a piece of that pie, but now it's a bigger pie to get. Does that make sense? Okay, because if you're sitting over here in the contributor role and you're pissed off at creators because they're making all the money, getting all the tax benefits and don't pay taxes and all this other stuff, you have to understand there's a reason for that. It's not like an accident. The system is designed that way. And so if you want the financial freedom, if you want the generational wealth, if you want this time that you're talking about with family, if you want to get out of the rat race and you want to do these things, do what I did, right? I was a contributor for years. But then what I knew, I said, I want to get out of this, man. I got to get out of this. But how am I going to do it? I have a 9-to-5 job. I work my ass off all day. How am I going to find the time to come over here and go buy apartment buildings so I can get out of this rat race? How am I going to do that? How bad do you want it? Because you're going to be doing basically a double duty, right? You're going to have the side hustle of a lifetime, because you're going to be doing your 9-to-5, no different than I did. Come home, deal with kids, family, spend time with family. Kids go to bed. 8 o'clock for a couple hours, I'm on the computer looking for deals, trying to find deals first, analyze them second, put them together, raise capital. Then you start to get deals, you close and you manage. And then after about 2 to 3 deals, I was making enough where I could start the transition. I could say bye-bye to the 9-to-5. Hello to Mr. Creator over here. And that's how you make the move. Okay, I did it myself. I'll show you how to do it. If you want to do it, not a problem. Okay, it can all be done. But does it take hard work? You bet your ass it does. Right? There's no free lunch, as we say, right? But it can absolutely happen. And as they say, closed mouths don't get fed. I was telling that to the staff today, because they got we got a leasing game going on in a challenge for the rest of the year. I said, guys, closed mouths don't get fed. There are hunters and there are gatherers in this life. There are hunters and there are gatherers. Hunters go out and they get and they make it happen and they help everybody else feed. Gatherers just gather. You have to have both in life, right? Society has to have both. But what are you? If you think you're a gatherer now, but you want to be a hunter, not a problem. I used to be a CS personality. I don't know if anybody's done disc testing. I used to be a CS, which is highly analytical, okay, and S being a soccer mom, meaning I avoid risk. I'm very organized and analytical, and then I avoid risk. I mean, that is the quintessential paralysis by analysis. I might as well get a cubicle job, because that is what I am designed to do if I just stick in that pillar. So what I said to myself is what I want. What do I want in life? And how bad do I want it? So you can't change your primary. Your primary is always going to be there. I'm an organized, analytical person. But what I could change is my secondary. So I became a D. I became a hunter, a driver, a director. I made things happen because I wanted it bad enough. I went and made it. I forced it. I got out of my comfort zone and I forced it. And so that's why we're at today. So the direct to broker approach is actually the best approach in your situation. And here's why. Most of you work. Most of you have a job and a career. You're working hard every day to feed your family and pay your bills. You have limited time. You have to be very efficient with your time. So you going out there, even though direct to seller technically, okay, is a great approach, the amount of time, energy, money, phone calls, mailers, everything you're going to spend to try and get a deal direct from a seller. For every single phone call you can make, or letter you can send, or door you can knock, or connection you can make with a seller, the brokers are out there making 5 to 10. They're 10xing you every day, every day. So you leverage the brokers in the marketplace, okay? You leverage the brokers in the marketplace to get access to the best deals. And I'm going to explain and walk you through an actual scenario right now, okay? But it is both, because neither of them are bad guesses. It's just for you, when you have limited time, you have to be very efficient. The direct to broker approach, because they're going to do all the hard lifting for you, your job is simply to make great connections. And I'm going to show you that. So here we go. So the direct to broker approach, this is how we got our first few deals. This is how we get most of our deals today. It's very efficient. You're trying not to pee up a rope. I know that's an interesting analogy, but if you can visualize it, don't pee up a rope. Right? It doesn't work well, right? It doesn't work well. You want to use the on market to get to the off market, right? It's the on to off market method. What do I mean by that? Okay, I'm going to give you an example. So before we came on tonight, I went ahead and I just pulled up multifamily properties in Florida. And I said, okay, I want to start looking for some deals. I'm curious. I like Florida. I think it's a great market. I want to go into Florida. So I'm interested in investing in Florida. Obviously, there's submarkets in there, but I started just scrolling through. And this is literally how we got our first 3 deals. And they were in Kansas City, Missouri. Is I went online, I picked out a couple properties I had interest in. It didn't matter whether or not they made financial sense. That was irrelevant. Keep in mind what you're trying to do. You're trying to use the brokers who are doing deals in the market, get to know them to get access to the off-market deals. And then you may be saying, well, Justin, why don't you just go after the deals on the websites? They're overpriced. That's the reason they're on the websites. They're overpriced and they probably don't make much financial sense. That's the reason they're there, because you have to understand the workflow for how multifamily and commercial real estate is sold. It does not start with websites. It starts with pre-market, where all the brokers, commercial brokers in the marketplace, they get a listing, they put it together in a nice package, they then send it out to all their close database people that have made connections with them first to get a first look. And if it doesn't sell through that pre-marketing process, then it comes onto websites like this, Crexy.com, LoopNet, CoStar, you name it. Okay, but it does not start there. It typically is the last resort, or after it passes through the pre-market process, now it goes to the websites. But you'd come in here and I'd take any one of these deals. Okay, any one of these deals. Could take this little 16 unit, whatever it may be. Okay. This little one right here. This is cool. So the multifamily company, cool. So I'd click on this deal and I would do this with 3 properties. So let's presume I wanted to go into certain area of Florida and I'd click on this. It's going to load here for us. And you scroll down here, you see our broker, Kyle, right? See our broker friend, Kyle, with the multifamily firm. So what I'm going to be doing to start building rapport and relationships to get access to these pre-market deals is I'm going to be coming in here. I'm going to make a phone call to Kyle. This is a little deal that I can call on and I could say, hey, Kyle, look, how many units we got here? We got 12 units. So the phone call would literally go like this. Hey, Kyle, how you doing? This is Justin Brennan with the Brennan Pulley Group. Hey, I'm calling on your Spring Village apartment, the 12 unit you guys put on the market about a month ago. How are things going with it? Great, great. Have you guys had like activity? Have you been in out of escrow? Kind of give me the status on it. Obviously the current situation and what the sellers are trying to do, why they're selling, et cetera. Okay. Yeah, it looks like a newer property. It was built in 2021. So you've had activity, it just hasn't gone in escrow yet. Okay. Any active offers currently? Okay. Awesome. Well, yeah, I'm definitely interested. I'm going to be in town in about a week. I'm going to be touring a couple other properties. This one caught my eye. I'd love to stop by. How are you guys handling tours? Are you guys doing group tours, maybe a private tour? Okay. So you guys are doing private tours? Awesome. Yeah, I'd love to set something up with you. I can send you over a little information, just introducing myself. I'll give you an email with my contact info. But love to set up a private tour when I'm in town in about a week and just take a quick info and get to know the property and obviously get to know you. Okay, awesome. Listen, they may ask you a few more questions or try and gauge you a little bit, which is pretty standard. There's a lot more nuance into this conversation that would go on, and that's what we teach and hold hands with. But you get the point. Because what I'm trying to do is go there, tour the property. I don't care if the deal makes no sense. It's completely irrelevant. What I'm trying to do is get access to Kyle. Because if Kyle is a market mover and has deals and other deals in the marketplace, I want to get access to those deals pre-market. Because this is how the process is done. Our first deal in Kansas City, same process. Called 3 brokers, 3 different properties, toured 3 properties, went out there, met them all. Those deals didn't make any sense. Within 3 weeks after making that trip, I started seeing deals pre-market come across my email. We started analyzing them. Some of them started to make some really good sense. So now we started to write letters of intent, offers on those properties, and start making deals happen. And that is literally how we got our first deal. Okay. So you use the on to get to the off. And you find the market makers in your market that are doing deals. And you target that 10 to 30 unit space where there's mom and pop brokers There's mom and pop sellers. The financing's easier. The capital raise isn't too big. It's very bite-sizable and it makes sense and it's not too scary. And then you can execute. And then trust me, when you get your first deal and you close escrow on it, the feeling that you're going to get of confidence is going to blow your mind. And then now all of a sudden you're going to be like, shit, I can do this. And why wasn't I going bigger? Right? Excuse my language, but not excuse my language, because I get excited about this because I go back to the first deals I did. And now I look at today, we're doing 100, 200 plus unit deals, but it all started with the small stuff. Everybody has to go there. Analyzing deals. And I'll brush through this, but that Multifamily Toolkit does a deal analyzer in there that you get that'll plug and play all this stuff for you. Once again, 2-unit deal or 100-unit deals are relevant. People ask me, Justin, what makes up a good deal? If I analyze it and it pumps out some metrics and returns, what should it be pumping out for me to consider it a good deal? Right there on the right-hand side of your screen. You want an IRR, an annual rate of return, somewhere between 14 to 20+% a year on the money. Cash on cash return, that's what COC stands for, 6 to 10+% per year. Equity multiple of 1.8x or more. Okay. And what I mean by that is if I put $100,000 into the deal, what am I getting out? So if I put 100,000 in and the equity multiple is 1.8, I'm getting 180,000 back out. 180,000 back out. I even forgot to mention, I don't even know if you're seeing, I got a sling on. I dislocated my shoulder about 3 weeks ago. I have to have surgery this week. Horrible. I don't recommend it. So don't do that ever. If anybody's ever dislocated your shoulder, holy cow, mine was a bad one. So it's pretty severe. So I have to have surgery, but do not recommend it. Do not recommend it. But analyzing deals, you start with the gross income on the property, right? How much potential rent? Then you're going to take out what's called economic loss. Does anybody know what economic loss is? I'm not going to like burn your bridges on it if anybody wants to chime in on that. But economic loss includes physical vacancy, what's called loss to lease, which is the difference between market rent and your rent. Maybe the market rent's $1,000 a month and you're getting 900. Loss to lease of $100. Okay. Bad debt. People aren't paying rent. Concessions. Maybe you got to give concessions to get people to move in. 3 months rent. That's a concession. All that makes up what's called economic loss. Okay. Then you add in other income. This could be pet income, admin fees, late fees, parking income, all kinds of other income. And that gets you what's called an effective gross income number, EGI. These are all things we teach. Don't get caught up in it too much tonight. Just understand the total kind of, if you're looking at it from a high level, this formula is the same whether you got a 2-unit property or a 100-unit property, okay? And then you're going to take out your operating expenses on that property, less the expenses. This could be repairs and maintenance, property taxes, insurance, all these things. Could be payroll if you have a payroll on site. Could be all kinds of general administrative expenses, on and on and on, okay? And then after you get to that, you get to your net operating income number. This is a very powerful number, net operating income. Because in order to value a building, to establish value for a commercial property, you take that net operating income and you divide it by what's called a capitalization rate in the marketplace. And that gets you the value of a building. Once again, if you're hearing things tonight that are like, don't worry about it. I'm just trying to give you some weeds, but some high level on it, okay? Then you take out your mortgage and you get to free cash flow. But that is literally the formula, right? There's a lot of line items in all of that, but that's the formula for evaluating and analyzing a deal. And then when you do that and you analyze all those numbers, it should produce the information to the right. And if it does not produce the information to the right, you don't do the deal. You don't do it because it's not going to produce a good enough return to be worth your time. Yes, Matt. Great question. Do all 3 metrics have to be met? Yes. Yes. Because they all interact. Trust me. Yeah, they all interact. You don't just want a high annual rate of return and a bad cash on cash. You need it to cash flow, but then you also need appreciation built into it with value add. That's how you get a higher annual rate of return. So yes, you need all 3. You need all 3. Great question, by the way. That is a great question. Raising money. Raising money. This is where everybody gets stuck. Would you say that this probably is where you start to quiver? Quiver. Most people do. because they're like, oh man, I found a deal that makes sense. I analyzed it. It makes sense. Great. We're making offers, but crap, man, I don't have the money, or I can't raise the money, or I don't know how to structure it. I only have $50,000 to invest. How do I do it? Right? If I have 50,000, how do I go buy a $2 million building? How would I do that? I'm going to show you that tonight. Okay, so here we go. So in order to raise money, people fall into the trap of thinking they need to have the money or access to the money or know people with money first before they go do anything else. No, that does not attract money. What does attract money is a great deal. It's a great deal. Ask yourself this question, because I was chatting with a buddy of mine before we came on, and I asked him, I said, Jason, tell me one person that you know that doesn't like to invest in real estate. Seriously, think about it. Think about, is there anybody that you know that if you went and asked them, dude, do you hate to invest in real estate? They'd look at you like, are you a moron? No, I love to invest in real estate. I would love to invest in real estate. I just need what? A deal that makes sense financially, and I need to trust the people that I'm investing with, right? So if it's not my deal, I need to trust the people I'm going to invest with. That's it. If you have a deal that makes financial sense and you trust the people that you're investing alongside of, boom. I don't know anybody. I don't think I've run across any human being that's like, no, real estate investing sucks and I don't want any part of it. I've never had that happen. So all of you on here tonight, you all want to invest in real estate. That's why you're here. You just need to know how to do it, how to structure, how to do things, how to get comfortable with it, how you can execute, how you can make it happen, maybe some hand holding if you want to learn it further, maybe a community to be a part of. So that way you feel connected with things and can grow and collaborate together, maybe. But all of that has to happen, okay? All of that has to happen. Deal that makes sense. You need a good pitch deck, That multifamily toolkit. And if for whatever reason you're having issues with it, we'll talk about that towards the end here. We'll connect. We'll make sure you get it. Okay, don't worry about it. Good pitch deck that explains what the deal is, what the returns are, how much money gets invested, how long is the investment, when do I get my money back? All of those things. A great pitch deck that's templated, you get it in that multifamily toolkit. Okay, we're giving it to you. Great one. And then a good process to bring the money into your system or bring it into your deal. Okay, so deal that makes sense, good pitch deck and a process. Raising money is not that hard. You'd be very, very, very surprised. Okay, very, very surprised. So that's key component.
This is a very common question that we get from whether it's people who are interested in the mentorship or people online that we can communicate with, that most people have not raised money before is the most common side of it. And so for someone who has never raised money, the mentality is sometimes like, well, I don't want to be like a burden or someone who's like going around to my friends. It's not like a pyramid scheme type situation. They don't want to have that feeling of like, I'm going asking, people are going to stop taking my phone calls pretty much. Is common, I would say.
Yep. Totally normal. And then Matt made a good point here. He says, just who to talk to, right? I'm shy. How do I talk about money? It's taboo to most people. Fair points. I mean, all very valid points. So I ask you to switch your mindset for a minute, which is why I brought up just a minute ago, there is no one that I have ever run into in the history of my 44 years on this planet that ever has told me they don't want to invest in real estate. That's never the response. It's always, do you have a deal that makes sense? And do I trust you? Keep in mind, you're not asking people for money. You're providing them an opportunity because people want to invest in real estate. They want their money to grow. Most people are investing in other things like 401ks, stock markets, bonds, CDs, crypto, other things. They want to invest in real estate. They just need an opportunity to do it. So when you go and you put this out there, you have a deal that makes good financial sense. You're not trying to go raise money for a shit deal. Excuse my language, right? You're not raising money for crap. You're raising money because it is a good deal. So of course you're like, man, I have this great opportunity, John, and I'm just putting it out to people I know, people I don't know. We're bringing in some money and we're bringing it together with some other people. Minimum investment's $25,000. who do you know that may have interest in getting involved in a multifamily apartment deal? It's going to return an average of 20% a year on their money. And their response is probably going to be, gosh, I don't know, but can you send me some information? Absolutely. I can send you the pitch deck. And it's going to go through literally 95% of the questions that any potential investor may have, and answering everything about it, what the deal is, how much money, minimum investment, projected returns, how long the money out, when do I get it back, what's my total in, my total out, all that stuff it's going to answer. That's what a great pitch deck does. It does 95% of the work for you, but you need to have one of those. We're giving you that tonight, and we give it as, like you said, Shai, everybody is part of any communities and collaboration, they get that too. That's a key component to raising money. But if you flip the mindset away from the taboo into, I'm providing an opportunity. No. This is not like me asking, like, I need. It's, hey, I have a great opportunity. You want to invest in real estate. This is a great one to invest in if you have interest or know people that do. And here we go. And if you don't, not a problem. We'll go over here. So don't get caught up in that. Just have a good deal. Just trust me, if you have a good deal and you have a pitch deck and a process, raising the money is not that difficult. My first deal, we raised $900,000. I'd never raised a single dime in my life. Okay, first deal, 27 unit, we raised $898,000 into that deal. And we did it with 7 people. And I thought, no way. I'm like, I can't do it. I've never done it. I don't know how to do it. All the limiting belief systems that everybody's going through in their mind right now, I did. Until I realized, crap, I have a really good deal here. I believe in it. I believe in this deal that I'm talking about. And I just literally put a pitch deck together, blasted it out to a small group and database. They shared it with a few more people. A few more people shared it. They all called me back. They wanted more information. Next thing I know, I had 5 to 7 people teed up. Boom. Took us like 3 weeks. Done. I mean, you'd be shocked. I mean, but you got to get out of the limiting belief system. So that's how I would answer that question, Shai. We help you get out of the limiting beliefs, right? Because that's a key component to it, because it's not that hard. And if you have that kind of roadblock, we're going to slap it out of you, and we're going to get the right mindset going. Okay. Yeah. Love that.
On
Does that answer that question at all?
Yeah, absolutely. On the money question, actually, a little bit more, this is more, I guess, tactical than like whether or not it's possible or not. But like, from the day that you sign or like get the deal under contract, how much time do you have to then go raise the money?
Yeah. So most escrows are 60 to 90 days. 60 to 90 days. And you have contingencies in place for financing, due diligence, like inspections and stuff that usually run around 30 days. You have financing maybe up to 60 days. And then you have up to 90 days sometimes on the close of escrow. So it differs. Okay. Does that make sense?
Yeah.
Yeah. So the typical process that anybody understands, just real quick on the weeds. Let's say I got a deal accepted today. Well, there's usually going to be about a 14-day lag between acceptance and the actual contract and opening of an escrow. So you got 2 weeks there. Then you have another 3 months before you're closing the deal. Okay. Plenty of time. But that's also why you keep it bite-sizable. I'm not coming on here saying, go after a 50, 60 unit deal, everybody, and you have to raise $1.5 million in 30 days, and you've never done it before. Best of luck. Right? Because like I said earlier, you might as well go try and break into the White House tonight, because that's about as good a chance you have doing that. Right? I'm teaching exactly what we execute, exactly what we're doing today, exactly what other people are doing today. We're executing, and we have proof in the pudding, and we're doing it all the time. So keep it focused, keep it bite-sizable, keep it tangible and realistic, and then you'll make it happen. Okay. Great question came in from Javier. What structure do you use to put the money together? An LLC, single purpose entity. I'm going to show that to you in just a second. So I'm going to move past closing and managing, because I told you we're going to focus on the raising money, finding, analyzing, raising money. So let's get into structure, because that's kind of the raising money part. Okay. So here you go. You'd asked a great question, Javier. Here's your answer. So you're going to have an LLC that owns the property. It could be the address, llc.com, whatever you want. So like this one, it could be, 1013 East Street LLC. So it owns the property. Now you have ownership of that LLC. You are the general partner. So as the person putting the deal together, you found it, you've analyzed it, you're kind of, you're bird dogging, you're managing the deal, you're putting it together. So for that, you're the general partner, right? That's you. You're typically going to bring in 10% of the money. All your investors are your LPs, your limited partners. They are passive investors in the deal. They simply are writing a check. They have no voting rights, and they get their check back with interest. Simply put. Okay. So let's focus to you on the left. So as I'd mentioned, you get paid 5 to 8 different ways in the deal. And I'm not going to dive into crazy stuff about these tonight because we could sit here for 4 hours. But you get acquisition fees. That's a fee for putting the deal together. Very standard. Asset management fees paid monthly. Monthly cash flow. Cash distributions that come out, right? Tax benefits. Distribution fees or dispo fees when you sell the deal down the road. Finder's fee, you could get paid a finder's fee for finding the deal. Or if somebody else found it, you can get paid for literally finding deals. Construction management. Let's say you're doing some renovations, right, on the property. Whatever that hard cost is, you can get paid a fee on that. So there's multiple ways you're getting paid, both monthly and one time throughout the life cycle of owning an apartment building. You. Now your limited partners over here, they're going to invest the money. Your money is also invested alongside them. So you're actually your own limited partner in your own deal. So you get your percentage of that side as well, plus you get your percentage on the other side.
Actually, yeah, Justin, this is another common question that we get is people who say like they try to go structure their LLCs, and I don't know if it's the companies who are doing it or what, but they give them all these options of different type of LLCs and different states you're supposed to do it in and all these kind of things. Yeah. What would your kind of like advice or like recommendation and those type of stuff be?
Yeah. So there's 2 LLCs, by the way. 2 LLCs. So you have your investing company. So your general partner, right? You see it over there. You have your investing company. That's your holding company. You can have that LLC anywhere you want. It could be in any state you want, typically the state you live in. But if not, you can have it be Wyoming or Delaware, which are 2 of the best. Okay. So that's your holding company. That's like your investment company that has a brand behind it. So that's that. Then each individual property you buy, each 10, 30 unit apartment building is going to have its own LLC that owns it. And that's going to be in the state in which the property is located. So if it's in Florida, Florida LLC. If it's in Arizona, Arizona LLC. Make sense?
Yeah.
Yeah. So that's how the LLCs are going to go down. And they're very simple, just a normal LLC. Yeah. But this is how the structure is going to go and how you're going to set it up in a very simple structure where you have general partners and limited partners. And like I said, you bring in 10% of the money. Typically, you're getting 30 to 40% of the deal for bringing in 10% of the money. Okay. 10% of the money. And then on the other side, you're also getting a piece of that because you're your own limited partner in that investment. But the limited partners tend to bring in about 90% of the money. And for that, get about 70% of the deal. Does that make sense, Shai?
Yeah. Yeah.
Okay.
Makes perfect sense.
Awesome. So let me give you a case study of this actual deal. Okay. I'm going to give you a case study on how I bought a 31 unit for $18,000 out of pocket. Exactly how we did it. Let me walk you through it. So 31 unit deal. We bought it for $1,525,000. We put about $400,000 in renovation cost into it. The closing costs, title escrow fees, my acquisition fee, everything was built into that closing cost number of $225,000. So we were all in costs of about $2.15 million. Okay. We went out and got a loan for 70%. So in terms of how the money breaks down now, 70% loan for $1.5 million. Now we have that down payment equity. That's $645,000. So that's what had to bring into the deal. I, as the general partner, remember this whole thing? 10%, 10%. So I brought in 64 grand into the deal. 90%, remember this structure over here? 90% was brought in by the limited partners. So they brought in 90%, about 581,000. So I brought in 64 grand. Now here's the cool thing. Remember that acquisition fee? Remember you get paid an acquisition fee? I got paid an acquisition fee at the close of escrow. So 64,000 went into the deal when we closed escrow. Literally the week we closed, $45,000, about 3%, came back out into my pocketbook. So 64 went in, 45 came out. You do the math. It's about 18 grand. So now I'm physically out of pocket $18,000, and now I have control and ownership as a general partner in a 31 unit, $1.5 million deal. Here's where it gets fun. Because keep in mind, I'm out of pocket 18 grand, right? Remember this. So now we go and we renovate the property. We improve it, make it all look nice. Interior renovations, exterior renovations, make it great. By that, we can raise the rents. We raise the rents almost $300 a unit. So now the property is worth $3.6 million. Bought it for 1.5, put 400 grand into it. We got super lucky with appreciation, 3.6 million. We refinanced that property. We pulled cash out. We paid off the investors. Now we're playing with house money. And in 24 months, we did that. And on top of that, and so now I get all my money back. Now my 64,000 comes back to me. Because remember, I also got the 40-something thousand acquisition fee. Plus I got money on top of that. Plus now I got asset management fees of 1%, which I'm making over here. All the profits coming out. So at $2,000 a month over here to the right, you can see I'm making $2,000 a month for 5 years. That's 120 grand. Plus the net profits on that deal from the sale, 470,000. So for $18,000 out of physical pocket, I made $590,000. I mean, Shai, I don't know what planet you're on here on Earth, but that's pretty good, would you say?
It's pretty good.
And that's not a unique case, guys. This is very standard. Now, some properties perform better than others, but the concept is the same, right? The key is leveraging. When we talk about OPM and learning this game, how do you take a limited amount of capital? So if all of you here tonight are sitting here going, okay, I got 30 grand in cash, I have 50 grand in cash, and I want to do this. How do I do it? Well, you just saw how we came in with 64 grand, got 45 out. So I'm out of pocket 18 physically. And now I have a 31 unit deal. So whether you get a 30 unit or a 10 unit or a 20 unit, whatever it may be, being able to come out of pocket 30, 40, 50 grand, right? And then get fees on top of that. So you're really only in a pocket less than that. Very feasible, even in today's market, because interest rates are starting to flatten out and come down. Things are starting to open up. Things are getting better. I mean, it's still kind of a tough market for multifamily, but opportunities are showcasing because of all the distress that's starting in the marketplace because of all the high interest rates that have been there for the last 2 to 3 years. So if now is a time, now is a time. Between the rest of this year, 2 months, and all of next year, phenomenal. Because by 2026, we're going to balance out and you're going to start to see rents rising again and things coming back around. You don't want to be waiting for that. Now is the time to get in and start taking advantage of some of these deals. Absolutely. Any other questions, Shai?
Yeah, actually, one that we get actually a lot is, is there any because people see single family houses all the time and there's obviously all the suburbs all over the place, but is there any shortage or saturation of the multifamily?
So,
or anything like that?
yes, no, and yes to that. So yes, there's a lot of new construction that's been built over the last, call it since COVID, of Class A new construction apartment buildings in a lot of the Sunbelt states, right? Lower half of the United States. So there is an oversupply of inventory in the short term that's going to be absorbed between the remainder of this year and all of next year. So by 2026, we're going to have a shortage, which is why I said rents are going up. So just that's going to answer that question. Is there in the smaller space that we're talking about, more of the boutique 10 to 30 unit space? Yes, there's plenty of deals to be had. Transactions are happening. Some are distressed, some are normal. But the key to the whole thing, guys, is finding pre-market deals. And you need to learn the science of doing that. And that's why people get, kind of come in and collaborate in communities and be a part of things so they can learn the nuance of how to find a good deal, how to analyze it. How do they get their hand held through it? Do they have people to review those numbers alongside them, right? Because as you know, Shai, I mean, everybody that's kind of in the community, when they find deals, they submit the deal analyzers. Our team, along with them, will help them review the deals and give them thumbs up on what to change, what to look for. This is right, this is wrong. Look at these numbers, tweak these, maybe consider this. So we're reviewing and analyzing the numbers alongside them. It gives them a vote of confidence when they're going in to make an offer. Oh my gosh, like this is good. It makes sense now. So analyzing the deals alongside somebody gives you the confidence to do that.
Yeah, makes sense.
Yeah. So, I mean, to answer, yeah, on the multifamily side, there's plenty of opportunities. I mean, the only hindrance right now is getting things to pencil, right? So you have to look at deals like you do all the time, but with interest rates. And sometimes you have an imbalance between what the sellers are expecting and what buyers can pay financially, right? Because interest rates still are up a bit. They're coming down, but they're still up. So you still have this dichotomy between what sellers want and what the market's really willing to pay. That's always the case. As I mentioned earlier, like, why did we start this journey a couple of years ago to create a community of well-trained investors around the country who are collaborating and doing deals together, learning, being mentored if they want to, but collaborating? And the reason why is because partnerships and collaboration are how you grow. Yeah, so the key is, like, how do you get from where you're at, which is maybe a deal you may already have or zero? How do you get from there to maybe your first deal? And then from your second to maybe your 10th or whatever it is. So as I said, we created Multifamily School Community, and we did it a couple of years ago. And it's a great community of investors around the country, collaborating, talking, doing deals together, partnering, all of that stuff. Capital's getting raised in there. All kinds of things happen inside there amongst the either the mentees or people in it, just learning whatever it is. And so that's how you grow, because people, we have learned, we all need hand-holding. Because we can be taught and we can read a book and we could say, okay, that's how you do it. Great. But as we all know, especially in multifamily, which is a bit more complex than just doing a single family, the hand-holding and learning the nuance, and especially going through the hand-holding in the moment in real time as you're actually going through finding, analyzing, getting a deal, buying a deal, getting into escrow, structuring it, the financing, the inspections, all the stuff that you're going to go through A to Z in getting that deal, it can be daunting if you don't have somebody holding your hand. So that's why the community was formed. And people come in, they're learning, some getting mentored, all that process. So if this is something you're interested in learning about, put your name, your email, and your phone number privately. You don't have to send it out to everybody. So do it to host and panelist in the chat. And we can have an informational call about the community, see if it's a good fit, see if it's something you're interested in. It's not for everybody. It's not for everybody, but if you truly are ready to do this, you know, if you're truly ready to say enough is enough and you're mad and you're like, listen, I've been watching all this stuff. I've been doing all this stuff. I kind of know it, but like, I want to make this truly happen and get into my first deal in the next 90 days. If that is something you truly want to do and make happen, then do that. Okay. Do that. And you're scared to walk by yourself. I get it. Scared to walk by yourself, but we do have a mentorship program, right? So we have free communities. We're providing you all this free stuff tonight. You can go in. We have lots of free stuff and tools that you can learn from. By all means, take advantage of that. But if you're like, listen, man, I've been doing that and I have knowledge, I have information. I'm here and I want to make it happen. And I want it to happen. We're going to make it happen. And I want it to happen in 2025 so I can get into my 20-unit deal, 12-unit deal. Heck, 200 units? Are you serious? I would love that. I would love that. And you know what's the beauty about that? Is a couple of our mentees, they got into their first 10 unit, then a 20 unit, and now they started sending deals, much bigger ones, into the community because they're like, listen, let's collaborate money and partnerships to go after these 100+ unit deals. Love that, because that's how you grow and scale. So I love that. Beautiful. So yeah, we have a mentorship program. We have a mentorship program and we have a mentorship community that you can come into. So, and to kind of just put that out there so everybody understands that and how it kind of works. And I'll put a link up where you can actually set up an informational call to gain more on it. So to come into the community in the program, okay? Typically it's $8,800. Don't worry about the money for a minute, okay? Don't worry about the money. The key to the entire thing is making sure you believe that it's going to get you a result. So set the money about, we can figure that out for a minute. What I care about is that you care and you want to do it and make it happen, and that you believe the results can happen for you. That's number one. But for everybody that's in here, because you're in the webinar, we actually cut off $1,000 to it. Okay. And for 7,800, you can get it. Okay. Just FYI. So if you have interest, you can come in and just learn about it, see if it's a good fit, see if it's not. Don't worry about the money side. We'll figure that out. But I want you to feel good about what you're getting and what's included in that. I want to open it up to Q&A because we're about 20 minutes past right now. I don't want to stay too much longer and be respectful of people's time. But any other questions you guys can think of that you kind of saw in the structure and the finding, analyzing, raising capital part, closing the escrows and managing any of the structure and the money side that kind of like you want some more questions and answers on before we kind of close it out tonight. But I'm glad that there's a decent amount of people that are interested. And thank you for sending that in. Got quite a few people that have put their names and phone numbers and emails in that are setting up some informational calls. So you got to take the first steps. You know, you've all heard it before. No one's coming to save you. No one's going to do it for you. You can sit here and hope and pray, but hope and pray is not a good strategy. I mean, if you truly want to learn and see what's available to you, this can do it. And maybe it's a good fit. Maybe it's not a problem, but should definitely set up, book it in that link, and a free informational call for you to learn more. So Shai and Kevin, you guys have any other questions before we finish up?
Yeah, actually, this is another one of the questions we always get is, do you need to have any prior experience before starting multifamily? Like, do you need to have done a couple single family deals or flips or something else before kind of jumping into this?
Yeah. So no, the answer is absolutely not. Does it certainly help? Because everybody has different starting points, right? I mean, I had a different starting point than some people in life because I had a dad that did it, not multifamily, but he did development. But I had a little bit of an uplay because I had some background in real estate. But no, you do not. That it's all teachable. It's all learnable. It's just a question of where your starting point is at.
Another question I get is, do you need a real estate license, or is it more helpful if you have a real estate license getting into this?
Yeah, so I have a real estate broker's license. Does it help you? Yes and no. I mean, because you have a real estate broker's license and you've gone through the process of getting that, there is some knowledge you acquire with it. So because of that, yes, it can help with the knowledge side of it, but it's not necessarily going to get you any deals or better deals or help you do it faster or anything like that. So yeah, that's a good question. Any other questions from anybody else? I had a great group of folks on tonight. Obviously, I want to thank everybody for coming on, spending your time with us, being respectful of your time. But yeah, stay in touch with us, whether now's the time or not, whether you're ready to take the leap or not. Like I said, don't let any of the money stuff you saw, there's ways around through that. What I care about is that you care and you understand and you're ready to take a leap and that you believe in the process and what's available and that's going to get you a result. It's all about getting a result. Lee Levy, where this question comes from, they're not in the chat. Well, what do you mean they're not in the chat? You have Shai and Kevin who are helping answer a lot of the questions. They're coming up with them because they get them a lot from folks. But do you have a question, Lee? Happy to answer it. So did another person. David, how much return does the investors get back when paying back? Does it end your obligation to them? So a couple things, David. So the typical annual returns for an investor in your deal, as I'd mentioned, you wouldn't do the deal or move forward with a deal unless it met those metrics of 14 to 20+% a year on their money. Okay, because you wouldn't be able to attract money from investors unless the returns for them were in that range or more. Because otherwise, I mean, it'd be like me coming to you, Dave, and I said, hey, I have this great opportunity, blah, blah, blah. It has a 7% return. Well, you'd be like, dude, I can get that in the stock market. Like, why would I go take the risk on real estate? So the projected returns have to be healthy enough, which they would be, otherwise you wouldn't do the deal. So that's the kind of how much return does the investor get back, right? And then when you pay them back, yes, you can set up your agreement with them to, hey, once you're paid back, you're out of the deal. And then now I own the thing 100%. But David, that's how you would do that. Okay. Is you would, you could pay off the investors and then you don't own them anymore. And you have 100% control at that point, 100% control. The Facebook group is free, Lee Kuntz. The Facebook is free. So if you download that multifamily, don't download it, click on the multifamily toolkit, get into the back end, you're going to see the free community in there, right? And inside that free community is the Facebook group, and it's a free community. So that way you can stay in touch with us because, hey, I mean, if the time's not now for you and you're not ready, understood, then, you know, let's collaborate on some of our free tools and information. That's what we're here for, and see where it goes for you. Because, you know, the time may not be yet for you. All right, everybody, I'll be respectful. We were right at the 9:30 time. We went over, but listen, I love this stuff. I get passionate about it. I could literally talk all the time about it. And the reason we do this all the time is because educating, giving back, fulfilling is part of my, right, 7 mountains. And by creating the community, which is what we're growing, everybody's doing deals. That's how I'm going to be getting to 10,000 units. That's how you're going to get to your 10, 20, 100, 200, 500, wherever it is you want to go. That's how you're going to do it. So you're not going to do it alone, which is why I ask people why you want to, or why you feel maybe you want to or can't. And you certainly can try, but you're going to find out very quickly, multifamily is not a game of alone. It's a game of partnerships and collaboration and community. And that's how you do it. So.